Welcome to the Lend Academy podcast, episode number 95. This is your host, Peter Renton, founder of Lend Academy. We have a very special guest on the show today. Andrea Jung is the CEO of Grameen America. Prior to that, though, she was the CEO of Avon, a Fortune 500 company, publicly traded company. She is currently as well on the board of General Electric, a position she has held for 19 years. And she's also on the board of Apple, a position she's held since January 2008, over 9 years now. So she's clearly one of the leaders in business in this country, and she has chosen to work now for the nonprofit side of things, Grameen America, which is an offshoot of Grameen Bank, which was started by Muhammad Yunus, the Nobel Peace Prize winner. And we talk today a lot about the work that they're doing with Grameen Bank, why it's important, how effective it is, and what their potential is for the future. It was a fascinating interview. I hope you enjoy the show. Welcome to the podcast, Andrea.
Thank you, Peter. It's nice to be here with you.
Okay, so let's get started. You've had quite an interesting career. Why don't you give the listeners a little bit of background about yourself before you came to Grameen?
Sure. Yes, I think my background has been, an interesting journey all the way here to Grameen. I spent the lion's share of my career on the for-profit side of the equation, and mostly in strategy and marketing. I was in retailing in the early part of my career, and went to Avon in the very late part of 1993, 1994, where I started off as a mid-level executive in marketing and strategy in the U.S. division, and grew through the ranks to become the first woman CEO there in 1999, and was able to have the privilege of running, this Fortune 300 company for 13 years. And I stayed until 5 years ago in 2012, and had the opportunity to, be public company CEO, one of a few women leaders who had the opportunity to run, in our case, an enterprise devoted to promoting entrepreneurship for women.
Right.
In, hundreds of countries plus.
Mm-hmm. So then you moved straight from Avon to Grameen, is that right? And what was the reason for joining Grameen?
So I would say straight would be missing sort of a little bit of the real deliberation in my life about how I wanted to take on the next chapter.
Right.
I had a tremendous passion for women's entrepreneurship. At Avon, we had, again, millions of low-income, self-made entrepreneurs who really found the alternative and an opportunity and I saw firsthand the opportunity to change women's lives in countries all over the world through the ability to be taught to be entrepreneurs. So that always was something that had great power to me, and I saw that they did not only impacted their own lives and their own businesses, but it had a tandem impact on their families and the community. So I've been a big believer in women's entrepreneurship. And so in the period of time before I joined Grameen, I knew that I wanted to do something to give back. I knew that I wanted to be involved in social good. But importantly for me, I really didn't want to work just for, when I say this, I say it with a tremendous amount of respect when I say a typical nonprofit, but there are many, many incredible nonprofit organizations, but most of them are not sustainable. So they don't have an economic model that can, in fact, self-sustain. And I have always believed in, social impact models and social businesses that actually have a sustainable, scalable model, and they're hard to find. And so when I had the opportunity to talk to Muhammad Yunus in 2013 about really scaling microfinance in the United States, it was a collision of my passion for women's entrepreneurship that I had spent, 2 decades on with Avon, but also my deep belief that financial inclusion and the ability to access capital, if it could be done in a scalable, sustainable model, would really solve one of the big national issues that's in front of us. So that is why I decided to join Grameen America.
Okay, so then let's just talk a bit about the model, because I know that I didn't know about how the model worked until fairly recently. So why don't you go through and just describe how Grameen America works?
Absolutely. So how Grameen America works is that we are an organization that gives non-recourse loans to women in poverty in the United States. And so we are the fastest growing microfinance organization aimed to offer financial inclusion. So we give access to the loan capital itself for entrepreneurs. We help them asset build, meaning while we are not a bank, we help them partner with a financial institution whereby they can save money every week, because we think asset building is important. And then very importantly, we also think that credit building is important. So we partner with several credit agencies to make sure they have a nationally reported credit score and build a record of positive credit for themselves as well. So if you are a Grameen America member and you join us, within the first 6 months of the program, you can get your first access to a loan for your business. You can also open a savings account, a concessionary savings account, a no-fee account where you can save every week. And at the end of that 6-month first loan cycle, if you've had perfect repayment history on that loan, you can have a credit score that is, in that 670 range, which by any standard is very respectable. So, we feel that those are pretty great takeaways after just even 6 months of being in the program for women defined as in poverty in the United States.
Right. And it's interesting that, everyone knows Muhammad Yunus, obviously, and the work he's done internationally and, starting off in Bangladesh. So I'm just curious then, is your model the same that Muhammad Yunus really started in the 1970s? Well, if it's not, how is it different?
Well, I would say that the structural mission is very similar to the original Grameen Bank in that we believe in social capital and having groups of women getting together, offering sort of peer groups. They are not combined loans, so you're not being, one of 5 women doing the same business with one joint loan. You have your own individual loan, but you are getting together in groups and in centers with other peer entrepreneurs every week. And that mentorship and that sharing is very much part of the alchemy of the Grameen model. That's very similar to Bangladesh. What are different are, I would say, what are the kind of unique country differences in the United States? The size of the loans are different, obviously, given sort of the average income, et cetera, in this nation. So our loan sizes are larger than the average of the bank in Bangladesh. We are actually not a bank. The Grameen Bank itself is a certified financial institution, so they take the deposits, and the savings accounts are actually managed by themselves. We are not a bank. We are in a 501c3, so we cannot take deposits. So our savings are just done as a service by partnering with great bank partners like Citibank or Capital One, Wells Fargo. And then which I think is pretty specific to the United States, have a big importance in our program on building credit, and having a credit score, which is a very uniquely U.S. thing that is different than in Bangladesh.
Sure.
So the asset building and the credit building are done slightly differently. The loan sizes are different, but the fundamental structure of the model is fairly closely replicated. And I think that's the beauty of it, Peter, is that a lot of people know the extraordinary story of the Grameen Bank and the Nobel Prize awarded to Professor Yunus, as well as the Grameen Bank for the very counterintuitive thought by lending very small non-recourse loans to the poorest of the poor, who technically would be the biggest risk, had yielded sort of the highest repayment rates, and that was the poorest country on earth. And I think that what is wonderful is that sort of in the reverse innovation theory, that an opportunity to really address poverty alleviation could really come off a model from the poorest country to what's arguably still the richest nation in the world.
Right. So I'm curious about your core customer here. Obviously, it's a female entrepreneur, but
Yes, I mean, go ahead.
Well, I say, where, like, I guess, how do you find them? And I know you have this sort of group model where you have like five women together. How?
They are finding us in droves.
Okay.
Our core borrower for Grameen and our members are women that live at or below the poverty level in the United States who've got entrepreneurial drive to either continue to grow a business or start a business. Many of them they already have entrepreneurial endeavors, but they are not included in the financial system, so they're not able to get a loan from the formal capital markets. And some of them don't have a business yet, but this encourages them to be entrepreneurial as opposed to going to get a minimum wage job. So obviously, that is a large percent of women, in the United States that have this opportunity. 43 million people live in poverty in the United States. Women are disproportionately affected, and from a financial inclusion point of view, only 4% of monies given out to entrepreneurship are given to women in the United States last year, which is a pretty daunting statistic in a country like ours. So we are, extraordinarily passionate about being able to resolve this inequality issue on the lending front and make sure that they have access to capital. They find us through a variety of ways, but I would say it is a very, very high social capital model with word of mouth. We have loan officers who we call center managers in every city associated with all of our branch operations who find groups of women, whether it is in their churches, in their community, in the neighborhood, and they come together and very quickly, once we get a few hundred members, the word of mouth is so strong because, I have branch locations now out in Jackson Heights, Queens, for example, where almost every other storefront, if you go along some of the major avenues in that community, those store owners and entrepreneurs have gotten a Grameen loan and clearly share that with each other and bring others into the program.
Mm-hmm. So this brings up a good point. Like, what are the typical businesses that these women are? They retail businesses? I mean, what are they that they're actually taking?
They're really
loans?
split between products and services. So we have typical businesses on the service side would be, food services, catering services, salon services, hairdressing, cleaning services. So, we do have a lot of members who participate in the service economy. We also have, a great deal of participation in product sales, dress shops, selling jewelry, lots of people who have storefronts, food services, which range from food carts all the way up to, restaurants with several employees. This is what you're going to see within the Grameen membership.
Okay. So, it's interesting. You talk about oftentimes these women want to start a business and haven't, and it's one of the tough things. I mean, most people who are not below the poverty line they start a business and they get money from friends and family or from their own savings, and obviously for a lot of these women that's not possible. But the reality is you would think it's a very high risk proposition to give someone a loan to start a company. It's a first time entrepreneur. I mean, you'd never get that from On Deck or Funding Circle or any of the other major online lenders here. So I guess, I'm curious to know, well, let's just firstly talk about, do you give anyone a loan, or what kind of process do you go through to decide whether or not someone gets a loan?
Yes, and so the answer is no, we don't give anyone a loan, but what our underwriting thought process is, I think, is innovative and different, and which is what I feel the magic of the program. It is less important what business they are in, which may not be the case with your traditional underwriting, than their commitment to discipline. So in order to get a loan from Grameen, you have to participate for a full week, coming to get some basic financial training and learning about the program. By definition, if you cannot invest that time before you get the loan, we make the assessment that you're going to be a higher risk.
Yep.
Because time investment and discipline has been the key for this member to being successful more than anything else. It is less important whether she's a flower shop owner or has a food cart than that she understands the discipline of what it takes to be a micro entrepreneur in the U.S. economy. Secondly, she has to attend a meeting every single week. So at 7 o'clock on a Tuesday morning, before she opens her flower shop or goes and opens her restaurant, she is attending a meeting with approximately 25 to 30 other entrepreneurs in her community, and they share. And that peer pressure, peer mentorship, and peer sharing is a very big component, and they meet their loan officer at that meeting every single week. That sense of social belonging and camaraderie and mentorship is really the glue that takes the percentage of underwriting versus relationship and flips it upside down. Mm-hmm. We spend less time on the underwriting and all of our time on the relationship. The decision to give you $2,000 is far less important than the time spent with you after I give you that $2,000 to make sure you, A, pay it back, and B, know how to use that loan. And I think that's the difference, because at the end of the day, I do think that there are a lot of organizations and software programs that spend so much time on the front end where the disbursement of that loan or the decision to grant that loan is at the end of the process. For us, it's just the beginning. Mm-hmm. And therefore, the default rate, in my mind, rides wholly on the fact, which I think most people would kill for, on the fact that that relationship is so strong, there's such gratitude, and the relationship begins the day, not ends the day we finish the underwriting process.
Right. So let's just talk about that default rate. Can you share what your actual default
Absolutely.
rate is?
I mean, I can actually tell you that we've dispersed over $620 million of loan capital and written off less than $750,000. So that, the default rate is so infinitesimal. It's 0.3%.
Wow. I mean, that's...
and over 9 years, over a large portfolio, mm-hmm. over 13 cities. So we don't think this is sort of a one-off that is unusual, but might not be replicated. Charlotte, North Carolina is very different than East LA, is very different than Harlem. And in every single case, we're seeing the same thing. And that is because of the power and the relationship with that loan officer and the discipline of the system.
Right. Yeah, I know. I mean, there are plenty of small business lenders that have default rates 50 times that, and that they certainly would kill. So
that's the beauty of it. And again, I think that is the essence of the Nobel Prize that has now proven itself out in a very, very different set of circumstances in the first world, which is trust, loyalty, and gratitude, and a consistent discipline have everything to do with the success of repayment that other, traditional factors prior can't capture. Mm-hmm. There's no possible way to capture that.
Right. So this just what you say. You've talked about like $1,500, $2,000. I mean, what are the loan terms? Are they 6-month loans, a year? I mean, what's the interest rates?
95% of our loans are at 6 months. Okay. So now I would just say just call it 100%. We started off with some loans that were longer, but over time we found that the sweet spot is a 26-week loan. People want them for 6 months. Mm-hmm. The interest rate is 18% on a declining balance. So essentially, because they're 6-month loans, you're paying a little bit less than 10% but the APR itself is 18%, right, which we think is certainly from a microfinance organization, if you look at a lot of other lending institutions, a very, very fair and affordable interest rate. And that is a standard loan that starts no higher than $1,500 on your first cycle. Mm-hmm. But we do have loans well up over $10,000 for members who have been there with us for many years and who've got established businesses, who've got perfect credit and perfect discipline with the program. Right. So I have members who've taken up, $100,000, $80 to $100,000 in cumulative loans, but they've been small loans 6 months at a time with the discipline required at every cycle to ensure they stay, within the boundaries of good credit discipline.
Mm-hmm. These are these like monthly repayment loans?
Weekly. They are weekly repayment loans, which I think is part of, what some people get awed by. We found it to be an extraordinary continued measure of discipline and social connection. There are members who don't want to miss that meeting because they see their friends, their peers, they learn. Entrepreneurship is hard.
Right. Yep.
We've had people start off, with one kind of business, and through the learnings from others, switch to. So, for us, it's not about, you write a Harvard Business School type of plan for, business X where you're going to buy a sewing. I mean, it may not work out, but the ability to learn from others and switch to a different kind of business, it comes from each other more than it comes from us, and therein lies the beauty of the program.
Right. So I want to talk a bit about scale, because it's like you're running an offline business for the most part here, and it does seem to rely, you said, you're on people on the ground. So how are you able to scale this, and what is your view on scale?
I think we have hit a very fascinating sweet spot where we're fairly efficient. We've got 120 loan officers that, take 2.5 million repayments a year. So we would consider that, a wow in terms of efficiency per employee. Our average loan officer can handle up to 450. I've seen as many as over 500 members per loan officer. And that relationship, as I mentioned, is why we know we have this kind of almost perfect repayment rate. So for us, we are poised, even within our existing footprint, to serve over 170,000 women by 2019. We will have a portfolio outstanding of over $100 million, and program from inception through our 10th anniversary in 2018, we will disperse about $1 billion of loan capital. We call that scale.
Mm-hmm.
And we've been able to do it with the high-touch piece of the equation intact. We've used technology, and I mentioned this at the Lendit conference
Yep.
this week. We've used it to scale. The infrastructure and the cost of entry for us required technology in order to support the number of cities, the number of transactions. We are low ticket loan size, frequent repayment, and so that is volume with a capital V. In order to support that volume, we needed the systems and the administration to be pretty seamless. And so the investment in technology was really to enable what I would call the platform for scale. But the platform for success was that the technology allowed the human capital and our loan officers to spend all their time on the relationship as opposed to the administration. And therefore, that loyalty and their ability to know, where every single person's business is and their kids, and if they were sick with the flu, that magic happens because technology has freed up our loan officers from the, weekly repayment administration of, making sure that the $63 and $120 was collected times 450 people.
Right. Well, I remember you shared at Lendit that you gave the story about it where people used to come in and give you $20 bills and $1
yes,
bills,
absolutely.
And now you say it's now you've now moved away from the cash based model.
Absolutely.
Right.
I mean, again, not as a burgeoning nonprofit organization, we needed to rely on partners. We didn't have an endless IT budget,
right.
et cetera, but we have had extraordinary support in terms of partnering for cloud-based lending platforms with Mambu, with major financial institution partners like Citi and MasterCard, who've helped us go from dispersing checks every week where they go and cash those checks across the street at a bank to being able to have a card essentially where they can, essentially buy their inventory and business expenses without having to manage that in cash. So I think that the concept of the, cashless and mobile banking world has definitively come to those low-income members who we think having access to technology and tools is as important for their lives, not just their small businesses. And this is something that we're offering as well, is education on the power of a smartphone.
Right. So I want to talk just a little bit about the revenue model. I mean, obviously you're making money off the interest
Yep.
that can pay for your expense. I mean, what about your funding? I mean, you obviously you have donations, I'm sure, but do you get?
Yeah. So the basic rev model is that it takes Grameen in any given location approximately 5 years. We've done it actually faster, but let's just say on average about 5 years to get to self-sustaining. And that is with approximately 4,000 members and an outstanding portfolio of about $5 million with the interest rate I talked to you about, and the staff that can support those 4,000 members in our model. That's extremely replicable because we've seen now 5 times that once a program ages, we can then self-sustain. And that obviously is a beautiful and incredible achievement that no other microfinance organization I know of in the United States has reached. So if we were just to sort of stay static and not expand, we could be completely self-sustainable, not just at the branch level, but at the total enterprise level, probably in the 2018, 2019 timeframe. But of course, we want to expand. So the philanthropy really helps us with new cities because for the first, it's the venture philanthropy, if you would. It's investing in a model that will turn positive and profitable, so to speak, with quotes around the profitable, because all profits will go back into the program.
Right.
But the funding really helps us launch and cover operating expenses and portfolio for the first 5 years of the program. And that is a combination of major foundations, major financial institutions, and, major family foundations and individual donors. We do have another piece of the model that's funded through friendly patient capital. So in addition to outright cash grants, we take advantage of PRIs and, loans to Grameen that have very low interest rates and long tenors that we can, utilize. And again, we can cycle those loans, pay them back, but in the meantime have been able to garner our own income from the interest as they cycle through on a 6-month cycle. So
right.
We have a combination of friendly debt and philanthropic grants that fuel any given operation up until about 5 years.
Okay. So what are the cities, where are the locations that you're operating in today, and where are you looking to expand?
We have 13 cities today. We have 7 branches in the New York boroughs. New York was where we piloted the program in Jackson Heights, Queens. And, we are now serving over almost 50,000 women in New York City, which is pretty amazing. And we are in Boston. We are in New Jersey now with 2 operations, one in Union City and one in Newark, which just recently opened in November. We are in North Carolina. We are in Texas. We are in Nebraska. We are in Indianapolis, Indiana. And we have 4 branches in California as well. So we're truly national. The next branch we will open is Miami, Florida, which will be sometime in mid-2017.
Okay, so then so basically you're opening up a new area like once or twice a year, it sounds like?
Yes.
Okay.
Yes.
Okay, so but before I let you go, just one last question. So what are you working on right now that excites you about the business? Was there anything new, or is it just keeping on doing what you're doing?
We're working on a lot of things that excite us. Let me just start this sort of threefold. I would just say one is just expansion in geography. The second is sort of technology. And the third is just even mission-wise, a program. So what we're working on that excites me from a geography point of view is that, I think it's no longer a pilot. I mean, we have a proof point that we can impact a material number of women and families in poverty through entrepreneurship and access to capital that can actually make a material dent in their pathway out of poverty, as well as their ability to contribute in a major way to their neighborhoods and communities as burgeoning entrepreneurs. And I feel like we've hit an inflection point that this is a scalable national material impact. So the cities, Miami is next, but we had a very powerful piece of pro bono help done with McKinsey back in the late 2013, early 2014 that helped us identify, where this program could grow. And I think it would be of no surprise that there are many other additional cities, whether it's Houston, and Dallas, whether it's Detroit and Philadelphia and Chicago. I mean, there are so many. Unfortunately, the issue of income inequality and dense poverty is a national issue. Mm-hmm. And, I'm a big believer that our geographic footprint is a way to really continue this scaled approach to a material impact on the issue. Secondly, from a technology point of view, I think that, chapter one was how would a technology make Grameen America more efficient so that we could scale, so that the infrastructure would allow us to handle this many transactions. The next chapter that we're working on now is really how technology can impact and enhance each of their businesses. If they are running, a restaurant, how does technology actually help them? How can we teach them tools? How do they understand how, whether it's social media, Yelp, all the things that we can do to help them grow their businesses through the power of technology. And so it's, access to technology and tools, not just for us as the organization, but for the members. That's really the next chapter that I think could be very exciting in terms of impact. And the third thing are other programmatic. We're testing for the last year an extraordinary program that offers our members in our oldest branch, Jackson Heights, access to preventive health care and education. And we have found some really outstanding outcomes that say, is there the opportunity that Grameen America not only offers financial inclusion, but some education on other services, other benefits that are needed, because we know that the pathway out of poverty is holistic and not simply financial inclusion. So this opportunity to introduce them to some, basic healthcare, some navigation within their community if they've got issues, to free services. I can give you just one quick example. There are many free services for women in poverty for a lot of diagnostic screenings for cancer, colorectal cancer, breast cancer, cervical cancer. Again, the fear, the lack of education, and the ability of their trusted officer at Grameen to help navigate them to take advantage of these services has gotten the participation up in the high 80s and 90s of some of our members to take advantage of some of these services, which is 10 and 20 points above the actual city's average goal. So this would be an example of a really powerful impact that we could expand now that technology has taken sort of the administration out of our hands. How do we use that time to effectively shape and introduce our members to really beneficial services that will help them even further?
Right. Well, we're out of time, but geez, that's a fantastic story, Andrea. I wish you all the best.
Thank you so much, Peter.
You're really making a difference here and I think there's, we need more organizations like Grameen America.
Thank you so much.
Okay.
Thanks for the time.
See ya.
Bye-bye.
Bye. I just want to go back to that 0.3% default rate. Let's just think about that for a moment. These are small business owners, sometimes with little experience in underprivileged neighborhoods, that I can imagine no traditional lender or even online lender would even consider lending money to most of these women. And yet Grameen America is doing it, and they're doing it at a default rate that is, I would argue, better than any small business lender in the country. Now, they have an offline model. I realize that this is not an online lending business. However, I think there's a lot we can learn. I think that what struck me is it's the social connections that these people make, not just the women with each other, but with their loan officer. That's something, if we want to get in the online lending space down to that kind of default rate, we really need to sort of duplicate this offline connection that these people have, duplicate it in an online way. Now, I know there are companies that are working on this, but I think, Grameen America has a model that I think every online lending company should be paying attention to and seeing what can they do to actually create their business to be a little bit more like Grameen America. Anyway, on that note, I will sign off. I very much appreciate you listening, and I will catch you next time. Bye.